Wall Street is bracing as earnings season kicks into high gear tomorrow. For more on what to expect, let's get to Bob Pisani at the New York Stock Exchange. Hey, Bob.
Hi, Melissa. The earnings picture is about to change, and Jamie Dimon may be a big help. The trading community is on edge as J.P. Morgan gets ready to kick off earnings season. That, of course, is tomorrow. Now, analysts have been fretting that earnings have turned negative for the first quarter, now expected to be down 2.5% for the S&P 500. This is the first down quarter since the second quarter of 2016. But early returns indicate analysts may be a little too pessimistic here for a change. Overall, 25 companies have already reported first quarter results. 84% are beating expectations. That's a lot higher than normal. But the more important thing is they're beating by a much wider margin than usual. 7.5 percentage points they're beating by. That's much more than the typical 3.5% beat. So why is this happening? It's happening because analysts overreacted in December on concerns over a global slowdown led by China and Europe, and they cut the numbers too much. If companies beat estimates by anything close to 7 percentage points, then earnings for the first quarter are likely to be up in the low single digits, not down. No earnings recession. The markets could still, by the way, turn down if economic data from China and Europe continues to decline. But the biggest obstacle the market faces might not be earnings. It's just valuations. Stocks are expensive right now. Back to you, Melissa.
All right, Bob. Thank you. Bob Pisani at the New York Stock Exchange. We discussed that before about how the S&P 500 in terms of forward valuation, is that about the same level as it was before we really pulled back severely last fall? Some sectors have actually exceeded their forward PE ratios. How do you feel about valuations here?
Look, if we're in I hate to always do this, but we're in a 2.4 10-year, and we're in 2016 where people are thinking we're in and out of recession, and they're basically, there is a TINA approach to this, and you get to a place where expectations are really negative, as Bob pointed out. I don't care so much about the valuation, frankly, because the market has been able to price whatever it wants.
Mm-hmm. Mark?
I agree. I mean, the whole TINA thing, I mean, where else are you going to put your money to work? You can't make any money in cash. You can't make money in bonds. So you have to put it in stocks. As far as earnings season is concerned, what we are really looking for is some good guidance. You know, even if earnings are bad, you can easily get through a bad quarter by providing a very, very positive outlook.
All right, well, as earnings season gets underway, our next guest says there are a few stocks poised to be big winners and one name that's looking like a no-touch. Let's go off the charts with Rob Sluymer at Fundstrat Global Advisors. Rob, what are you looking at?
Great. Thanks, Melissa. I think it's really important to stay focused on the very long-term perspective of the market. Again, we kind of keep coming back to this point that coming off that 200-week moving average back in 16 and again in December of 2018, to us, that's a major cycle low. The market has moved back into a lot of resistance here. There's a lot of concern in that 28, 2,900, 3,000 level that the market starts to get overbought. This indicator in the bottom, it's the percentage of stocks with rising weekly momentum. So how many stocks are actually turned up and rising? And the key point here, similar to what we saw back in 2016 when the market went through a little bit of a pause after that initial surge, we're seeing the same thing. Now, we highlighted this indicator a couple of weeks ago. We're now starting to get this minor downtick. That's just telling us that less than 90% of the stocks, we're starting to see a few of these names start to drift off. So as we get into earnings, the market's relatively high. It's a little bit overbought. We think we get into a lot of churn. We don't think it's a major decline, somewhere in that 3 to 5% sort of decline level. But some of these leaders, some of the software names, some of the service, some of the processors have run a long way. There's still leadership. We still like them long term, but some of these names are starting to pull back a bit. And I think something like a MasterCard, you're already starting to see that relative strength roll over. We saw it in names in Adobe and CRM starting to go sideways. So some of these stocks, write some calls against existing positions, take some money off the table going to earnings. We're going to want to buy these names on pullbacks later on, but right up here, right now, we think we're going to get some sort of pullback, and we should bank some of that money going into earnings season. Now, on the other side, names that don't have a lot of momentum in them, that are laggards, names like Electronic Arts, went through this huge bear market in 2018. They're just starting to recover in that sort of 95 to 110 trading range. It's right at the 50-day. I think this is actually a very timely name. Expectations look low from a technical standpoint. And I think you could get this stock back into that 120 level, back where we saw it in 2018, sort of in the middle of that trading range. So I think that's really a timely name. And the last name I want to highlight, and I got to keep coming back to this stock because I think it's really representative of the broad market cycle. Again, similar to what we saw at the S&P, that big move off the 200-week, the 4-year moving average. And again here in 2019, that relative performance, started to improve early in 2015 into 16, and we're seeing the same thing here going into 2019 into the second quarter. So around these levels, we're buyers of the stock. We want to be owning the semiconductors, particularly on any near-term weakness. So we're favoring some of these more cyclical names as we move through the balance of 2016. Whatever chop, churn, and consolidation we get in the second quarter, we think it's an opportunity to continue to build exposure to the equity market.
Rob, why don't you come on over? Evan will bring the chair in. I think this music might be an upgrade.
Generic, awful music.
I think it could be an upgrade from the last.
An upgrade?
I kind of like it.
Growing on me.
Guy, you're not easily impressed by
No, I'm not. But do you want me to be easily impressed?
I appreciate the way you hold tough there.
Anyway, banks are kicking off earnings season tomorrow, Rob. So how are we looking?
So very weak. Long-term relative performance throughout 18 has still been in a downtrend. It has not recovered, but they're very oversold. I think expectations are low. The stocks have gone into consolidations for the last, call it 6 weeks or so, similar to what many of the energy names look like, and I think they could pop to the upside. I think it's going to take time for those stocks to rebuild their leadership. I think that's a second half story.
So, Rob, to the same thing about popping to the upside, I noticed a similar factor with energy names, where we've seen the oil complex move higher, but a lot of the subsector has sort of been sideways, kind of grind. Exactly. Do you see the same ability for energy to pop?
I do. The only comment or hedge I would have here is that oil's already run 60, 64. It's a big band of resistance right around its 200-week moving average. I think oil's going to come back a little bit, similar to what we see in the market. So I think it might be tough for those stocks to actually drive to the upside. If you push me on it, long, short, if I had to be there, I'd be long energy, I'd be long banks into earnings. I think they're pretty oversold.
Rob, this tug of war, the S&P 500 the last couple of weeks at these levels, does that favor the bulls or the bears in your opinion?
I think in the near term, the market's starting to stall out. I'd be taking capital off the table. That weekly chart we just saw, that momentum indicator, it's a pretty good way of getting a sense of the breadth in the market. It's starting to stall. I think the market starts to pause out here. I think we got about a quarter of sideways chop.
So we like MasterCard, but we own Visa. I think there's a better debit card presence there, so it should be able to weather the storm a little better in the event of an economic downturn. How do you feel about Visa?
I think they're basically the same chart.
Yeah.
More or less, right? Processors, financial processors, PayPal, MasterCard, all in established uptrends, cloud stocks, software stocks. There's got to be great fundamentals behind those names for those stocks to have ripped so far. I just think the positioning in a lot of those names is probably a little bit overdone. You get a little bit of a pullback. I'd be adding to those stocks on pullbacks.
Thank you, Rob. Good to see you. Rob Sluymer of Fundstrat. So he takes some money off before earnings season.
I've been thinking that for a long time, so it's been wrong. So, but I agree. And, stocks have to prove themselves. April 24th, you got Caterpillar and Boeing. It's going to be a huge day, so I'd really like to see what they say on that day.